Have you ever wondered how Microsoft, the company behind Windows and Office, is suddenly at the center of the global AI race? Their AI business is now running at a $13 billion yearly pace, up 175% year over year. But here's the twist. Wall Street might be missing the real story. With Q3 FY25 earnings coming up this week, let's dig in together and see what's really going on under the hood. Now, you might be thinking, isn't Microsoft just a software company? Actually, they're a cloud powerhouse. Azure, their cloud platform, is the #2 player worldwide, right behind Amazon's AWS and ahead of Google. This is where the real money and future growth are happening. With Q3 results just days away, let's see how their cloud story stacks up. Looking at the stock price, MSFT is down about 16% from its 52-week high, but still up 14% from last year's low. That's got a lot of investors asking, is this a dip worth buying or a warning sign? With Q3 FY25 results about to drop, let's look at what's driving these moves and what it means for us. Here's where things get interesting. Microsoft trades at a premium. PE is 31.6x. Price to sales is 11.1x. Some people might say that's expensive. But when you compare their margins and growth to other tech giants, you start to see why investors are willing to pay up. Let's break it down together before Q3 earnings. Now, let's talk about the engine behind Microsoft: revenue and margins. Last quarter, they brought in almost $70 billion, and for Q3 FY25, analysts expect about $68 billion. Margins are holding steady at a strong 45%. That means not only is Microsoft growing, but it's also staying super profitable. That's rare for a company this size. But what's fueling this strength? Let's keep going. Here's the real rocket fuel: AI. Microsoft's AI revenue is up 175% year over year. Azure Cloud is still growing at 31%. That's huge. Imagine a company this big growing like a startup. No wonder everyone's talking about their AI and cloud bets. But is it all smooth sailing? Let's see how they compare to the competition. Let's put Microsoft side by side with other tech giants. They're beating the average on revenue growth, profit margins, and even have less debt. That's why so many investors see Microsoft as a safe bet, even when the market gets shaky. But as you know, every company has its risks. Let's talk about what could go wrong as Q3 approaches. Okay, let's be real. No company is bulletproof. Microsoft faces big risks: government regulation, fierce cloud competition, and the massive cost of building all this new AI infrastructure. There's also the chance of a global slowdown or even a major cyber attack. But here's the good news. Microsoft is already working on ways to handle these risks. Let's see how they're investing for the future, especially with Q3 earnings in sight. Some of you might be wondering, what about Microsoft's impact on the world? They're aiming to be carbon negative by 2030, and their board is over 90% independent. But with all this AI growth, privacy and ethics are under the microscope. It's a balancing act, and regulators are watching closely. Let's see how they're spending their money to stay ahead. Here's where Microsoft's discipline really shines. In the last year, they invested $87 billion, mostly in AI and cloud. But they didn't forget shareholders. Almost $50 billion went back to investors through dividends and buybacks. That's a company that knows how to grow and reward its owners. Now, how's the stock looking on the charts? Let's check the technicals. Microsoft is down 16% from its high, but there's strong support around $356. If you're a chart watcher, keep an eye on $410. If the stock breaks above that, we could see a new rally. But remember, technicals are just one piece of the puzzle. Let's weigh the possible outcomes next. Let's play out both sides. Bull case, AI and cloud keep booming. Margins stay high, and MSFT heads for $500. Bear case, cloud growth slows. AI costs eat into profits, and the stock could retest 350. It's a tug of war, and the Q3 earnings call could tip the balance. What do the experts think? Here's what the pros are saying. Most analysts rate Microsoft a buy, with an average price target of $495. That's about 25% upside from here. The most optimistic see $600, while the lowest target is $415. It's a wide range, but the street is leaning bullish. Let's wrap up with what matters most for you and me. Let's step back and connect the dots. Microsoft's cloud and AI bets are driving record growth. Margins are best in class. The stock isn't cheap, but for good reason. Risks are real, but so is the potential. If you followed along, you now know more than most investors. So, what's our final verdict? All right, so after everything we've seen, here's our call. Hold. Microsoft is still a long-term leader in AI and cloud, but with the stock down 16% from its highs and Q3 FY25 earnings coming up on April 30th, we think the risk and reward are pretty balanced right now. Analysts are aiming for a $495 target. That's about 25% upside. But near-term volatility is likely as everyone focuses on Azure growth and AI margins. The next big moment? That earnings call. We'll be watching it closely, and our Q4 preview is coming soon, so don't miss out. Hit subscribe for updates. So, after all that, what do you think? Are you as surprised as we were by how much Microsoft has riding on this next earnings call? If you learned something new, hit subscribe and join us for more easy-to-understand stock videos. Got questions or your own take on Microsoft? Drop them in the comments below. Thanks for being part of this journey. Let's keep getting smarter together, and see you next time.